Financial analyst, stockbroker, author, host of the Peter Schiff Show, and the website is europac.com. Of course, Peter Schiff accurately predicted the house price crash and the 2008 economic collapse, and he joins us right now. Peter, welcome to the show.
Well, thanks for having me on, and you're doing a good job sitting in for Alex.
Thanks, appreciate it. So the Dow basically dropped about 300 points today. It's gone up a little bit since. Given that it took this long to raise the interest rate by such a small amount, what does that tell you about the confidence that the Federal Reserve has in the health of the U.S. economy?
Well, it doesn't tell us anything. The Fed was talking about the fact that it was going to raise rates later in the year, that they thought the economy would be strong enough so that it would be appropriate to raise rates before year end. And of course, the analysts were expecting the rate hikes to come a lot sooner. People thought they would have done it at least 2 or 3 times by now, but the Fed kept passing and kept talking about how they were data dependent. All of a sudden, they got to December. There's 2 weeks left of the year. Rates are still at 0. And I think they thought that if they didn't raise them now, they would lose their credibility. It would prove that the economy was too weak to withstand a rate hike. So I think to try to create a false sense of confidence and to try to save some of their credibility, they raised interest rates by a token amount in a symbolic gesture to try to save face and create confidence. And you know what? It's backfiring on them, as I thought. The market is down substantially. Dow's down, about 250 points as we speak. It was down almost 300. It dropped 250 points yesterday. But the real carnage is going on beneath the scenes. Look at what's happening in the high-yield bond market. Look what's happening in some of these leveraged funds. We're seeing all sorts of things blowing up. It looks very much like the way the markets were looking in the months leading up to the 2008 financial crisis.
And Fed policymakers, I read, they're predicting a rate of 3.25% by the end of 2018. Is that even remotely feasible?
I don't think so. I think it could be negative. We could have a negative sign in front of the nominal rate before the end of next year. Look, the Fed doesn't understand the impact of its monetary policy. The Fed has done tremendous damage to the economy over the past 7 years. And now, as they're trying to remove the stimulus, all the damage is rising to the surface. So the Fed is expecting this recovery to continue. The recovery is over, and we are in the beginning of the next recession, and it wasn't a real recovery. When I talk about a recovery, it was a bubble masquerading as a recovery. The Fed inflated a giant bubble, and all we did was borrow a bunch of money and spend it. But meanwhile, the real economy, the structure of the economy weakened, and we have all this debt and all this speculation that needs to be unwound, and it's going to be done in a very painful way.
Okay, Peter Schiff, we'll be right back on the Alex Jones Show, InfoWars.com. Stay right there. It's the Alex Jones Show live with me, your host, Paul Joseph Watson. We're talking to economist Peter Schiff, europac.com. And Peter, you were getting into it just before the break. This illusion of economic prosperity has been maintained to a great extent by these low interest rates, making the debt at least serviceable. But how on earth is the Fed going to keep raising these rates when, as you said, there's no real economic recovery to back it up?
Well, they're not. I mean, they're just pretending that they can do it to try to create a false sense of confidence where there should be no confidence. But yes, the whole thing that's kept this economy afloat has been debt. If people have been leaving the labor force, as people have been losing their full-time jobs and they've been accepting part-time jobs, as more and more young people are spending more and more time in school because there's no jobs out there, we've been running up all this debt. We have all the student loans, we have all the auto loans, more people borrowing against their homes, on their credit cards. Everybody is levering up in order to survive, and it's all being made possible by the Fed. But eventually, this is going to come to a horrible end as this bubble bursts.
Now, a lot of our listeners own gold, as you know. I noticed that gold plunged after the rate announcement, the dollar surged, but gold has recovered a lot of ground today. What's the immediate future looking like for precious metals?
Well, gold was up before the announcement. The day of the announcement, gold was maybe up about $12, $15, and then it was pretty flat after they moved. And then yesterday, gold dropped over $20 and basically tested the lows for the year. Today, it's up about $15. So we have had some volatility ever since the Fed moved. But the interesting thing is we're not getting a big sell-off, which is what everybody had been forecasting. Now, what I've been saying is it was going to be a buy the rumor, sell the fact. Gold has been falling for years on anticipation of this rate hike. And now that we've got it out of the way, I think gold's going to get bought, not sold. And in fact, the anticipation is not going to live up to the hype because I believe it's a one and done. And I think the market is going to sense this as the U.S. stock market starts to fall, as the economic data continues to come out weak. In fact, the data we got this week, today, yesterday, even on Wednesday when the Fed hiked, the data was all horrible on industrial production, capacity utilization, ISM manufacturing, Philly Fed, even the service sector. Today we got number there. The service sector PMI plunged to the lowest level of the year. So the data is getting worse, and that's before the stock market started rolling over, and that's before the Fed hiked rates. So I think the gold market is going to smell that the next thing coming from the Fed is going to be the stench of a rate cut and QE4, and I think you're going to start to see a lot of buying in the gold market. You know, how quickly it's going to begin, it's hard to say, but I think there's a lot of upside potential in gold, and I think most of the downside risk is already gone.
Now, let's turn to oil because the Financial Times reports that, quote, the amount of oil now at sea is at least double the levels of earlier this year and is equivalent to more than a day of global oil supply. We've also got this flotilla, which Zero Hedge reported on, of stationary super tankers around Galveston, Texas. The last time we saw prices this low in terms of oil was during the last Great Recession. And even CNN's reporting, quote, the last time raw materials like copper and oil were this cheap, an economic depression loomed just around the corner. So, Peter, does this oil price crash signal the beginning of the next financial collapse?
I think it's one of the signals. It's not the only one. But yes, there is incredibly weak demand globally and in the United States. And if you look at the transportation index, Dow Jones Transportations, today it's at a 20-month low. It is significantly weaker than the industrials or the utilities. And you would think that this sector would be the largest beneficiary of cheap oil prices because oil is a big component in your transportation cost. Yet this is the weakest index. And that's because it's the most economically sensitive. And, you know, a lot of people are trying to blame the weakness in the stock market on the weakness in oil. I mean, that's nonsense. Talk about bad logic. The truth is that oil prices and the stock market are going down for the same reason, and that's because the economy is going down. And the fact that the transportations are the weakest index of all, despite lower oil prices, proves this. But I think what's going to turn the oil market is going to be the turn in the dollar, because once the dollar tanks, I think that's going to ignite a lot more global demand for oil, because I think the high dollar, the overpriced dollar, is suppressing global demand right now.
Now, I want to get into this after the break. We've got a long segment coming up, but Pew came out with this big study last week, basically said that the middle class in America has shrunk to a point where it no longer constitutes the majority of the adult population. What I found most interesting about this was what they considered to be middle class in terms of income. That's what I want to discuss after the break with Peter Schiff of Europac.com. On the Alex Jones Show Live, this Friday edition, InfoWars.com. Stay right there. We'll be back. We're back live. It's the Alex Jones Show, joined by Peter Schiff of Europac.com. I was just getting into this before the break. Pew came out with a big study last week. The American middle class has shrunk to a point where it no longer constitutes the majority of the adult population. Now, first of all, they consider the middle class to be a family of three earning upwards of $42,000 a year. I mean, Peter, with the cost of living these days, is it really accurate to say that somebody earning, an average of 21 grand a year is middle class? That makes no sense.
Now, we've really lowered the bar on the definition of middle class. Middle class lifestyle in America used to be something that the rest of the world couldn't even aspire to. If you remember the sitcom The Brady Bunch, which was even the 1970s, right? In The Brady Bunch, Mike was an architect. He had a job. But his wife, Carol, didn't have a job. She stayed at home and she worked with charity events. She did school events. One thing she didn't do was the housework, because they had a full-time live-in maid named Alice, and they were able to support 6 kids. That was middle class. And they had 2 cars. I'm sure they didn't have any loans against those cars. They probably didn't have any credit card debt. I'm sure Mike saved a lot of money for their retirement. That was middle-class life in America. Your dad worked, your mom didn't. You had a housekeeper. You had lots of savings. You had no debt. Today, you're talking about that family of 3. The reason it's 3 is because they're too broke to have any more kids. 1 is all they can afford, and you probably have both the husband and the wife both working, and together they're making $40,000 a year. They're probably up to their eyeballs in debt, car loans, credit card debt. Maybe they have student loans. If they have a house, they got a big mortgage. They've got nothing for retirement. They're flat broke, yet that's supposed to be the new middle class.
I mean, 2 breadwinners earning $42,000 a year, that's middle class. That shows you how low the bar has been set. And it's, it's like when they call them mega rich, the 1%, all these Occupy Wall Street people. When that 1% bracket includes households earning over $500,000 a year. So that's going to include, professionals, small, medium business owners, the people who create jobs and employ people. So these labels just don't conform to reality anymore, do they?
Yeah, no. I mean, imagine back in the 1930s or 40s or 50s or 60s. I mean, if you had a job, if you were a man and you had a job, any job, right? If you were a butcher, a baker, or a candlestick maker, your wife didn't have to work. You could pay the bills, right? Without her working. I mean, how much does somebody have to earn today to enable the other spouse not to work? Even if it's the woman that has a job and there's a stay-at-home husband. I mean, I would say that in order to enjoy the standard of living that was typical among middle-class Americans earlier, you probably have to have a guy with a job of at least $150,000 to $200,000 a year. That's probably what you need to earn to be considered middle class, back in the 1950s. How many people earn that money? Very few.
And liberals continue to blame this shrinking middle class on the, quote, 1%, which is really the 0.01%. They blame it on skewed income inequality, which of course is why they want higher taxes and wealth redistribution. Yeah, is that the real reason for the shrinking middle class?
Not at all. They have to take a hard look in the mirror if they want to find out why the middle class has shrank. This was the predictable outcome of their big government policies. What created the middle class was free market capitalism. It was the absence of government that enabled the middle class to emerge, right? It was a lack of taxes, a lack of regulation. But the minute the liberals decided to come up with all these rules and regulations to protect people, right? To protect people from being exploited or from the vigors of capitalism, right? Once we erected a massive government, we destroyed the middle class. We made the middle class much poorer. We basically killed the goose that laid all the golden eggs that enabled that middle class. And so now we have all this poverty because of the government anti-poverty programs. The widening divide between the rich and the poor is being manufactured by government, and now even more so with the help of the Federal Reserve that is really putting the nail in the coffins of the middle class.
Now, I wanted to touch on the minimum wage because there's a state rep, Democratic state rep in Missouri, Michael Butler, has pre-filed legislation that would raise the state's minimum wage from $7.65 per hour to $15 per hour. We've seen this already being phased in through local ordinances in places like Washington and California. Barack Obama's right behind it, at least up to $10 an hour. What impact would doubling the minimum wage in the United States have on the jobs market?
Well, it would destroy a lot of jobs. I mean, if you want to see what happens when you have a huge increase in the minimum wage, you can look at places like American Samoa. We increased their minimum wage dramatically years ago, and we decimated their entire economy. We plunged them into a depression. Unemployment went up to 30%. It was practically zero before the minimum wage hike, and inflation skyrocketed too. Also, you can look at what happened in Puerto Rico years ago when we did that. In fact, Puerto Rico today has a much higher unemployment rate than America because the minimum wage effectively is much higher there because the average pay scale in Puerto Rico is lower. So we're going to decimate, jobs with a big increase in the minimum wage. But the sad reality is before we even had a minimum wage, and the minimum wage was created during the 1930s, right? Part of the New Deal with Roosevelt. But before we had a minimum wage, American workers in real terms, adjusted for inflation, had higher incomes before the minimum wage than they do now. And one of the reasons the minimum wage is so destructive is because it prevents people from getting their first job. And your first job is what leads to your second job and your third job. It's where you get important on-the-job training. It is the first rung in the job ladder. And the more rungs that they cut off from the bottom by raising the minimum wage, the higher they make it for people to get on that ladder. And, the minimum wage law doesn't hurt businesses. It hurts people. It hurts individuals. It is a law that prohibits people from selling their labor if they can't find somebody willing to buy it for that minimum level. So you price a lot of people out of the labor market, and what do? They just end up on welfare, or they commit crimes and they end up in prison. It is a complete disaster. The government has destroyed so many lives with this minimum wage, and now they want to make it even higher.
I mean, I think it was you that made the video where you went out to a shopping mall or whatever and asked people if they supported the minimum wage. Basically, all of them did. And then you said, well, how do you like paying double for that flat screen television? And of course, they had a very different opinion. But I want to turn to the election.
Yeah, I was asking people at Walmart if they would be willing to pay 15% higher prices so that Walmart workers could get paid $15 an hour, and nobody wanted to do it. So, they all want the higher wages, but they don't want the higher prices.
Yeah, they did. They weren't even prepared to pay 15% more.
No.
But I want to turn to the election because, of course, we had the Republican debates this week. You pointed out in your recent article that the Fed always likes to keep this bubble inflated during the election cycle to help the incumbent party. Do you think that the Fed would make financial decisions purely on the basis of keeping someone like Donald Trump out of office and supporting a Hillary Clinton?
Well, I think the only basis that they make decisions on is political. I think that determines every move that they make. That is the sad reality. And Janet Yellen is a very partisan Democrat. She, believes in big government and the big government policies of the New Deal and the Great Society. She wants to see the president's party stay in power. I'm sure she wants to see Hillary Clinton as our next president, and she believes that Hillary Clinton will reappoint her as Fed chairman. So that's what she wants. She probably sees herself as a member of the Obama administration, just the way Ben Bernanke admitted that he saw himself as a member of the Bush administration when he was, spinning the economic data when he was chairman of the Federal Reserve. So I think she's going to do whatever she thinks is necessary to make sure that Hillary Clinton, and that's the most likely Democratic nominee, is our next president. And, she wants to keep Donald Trump or anybody else with an R in front of their name from occupying that office.
Okay, Peter Schiff, we'll be sure to have you back on the show. Thanks for joining us.